In 2008, the global economy was in free fall. Banks were collapsing, markets were panicking, and Warren Buffett made a single move that earned him over $10 billion in profit. Here's how he pulled it off, and why it could still work today. September 2008. Lehman Brothers had just collapsed, triggering the worst financial crisis since the Great Depression. Markets were down over 30%. Big banks were desperate for cash. Most investors ran for the exits. Buffett, he saw opportunity, not disaster. Goldman Sachs was in trouble. They needed billions fast to survive. Buffett didn't just buy stock like any ordinary investor. He picked up the phone and proposed a deal that was almost too good to refuse. Buffett offered $5 billion, but with strings attached. Preferred shares paying him 10% annual interest. Warrants to buy 43 million Goldman shares at a fixed price of 115. At the time, people thought he was crazy. Goldman stock was volatile, the economy was tanking, and nobody knew when the pain would end. But Buffett wasn't playing for days or weeks, he was playing for years. By 2011, the deal had already paid him $1.5 billion in dividends. Then Goldman wanted their shares back, so they paid him $500 million just to cancel the warrants, plus $2 billion to buy back the preferred shares. So what can we learn from this? 1. In a crisis, cash is power. It lets you buy opportunities no one else can. 2. Structure matters. Buffett didn't gamble, he negotiated guaranteed income. 3. Think long term. Real wealth is built in years, not days. Fast forward to today, interest rates are rising, markets are volatile, and tech valuations are swinging wildly. The next Buffett-style deal might not be in banking. It could be in AI, energy, or even emerging markets. The question is, will you be ready when fear takes over? This was one of Buffett's most famous crisis plays, but it's not his biggest. In my next video, we'll break down a deal that made him $25 billion from a single company you use every day.